Awesome. So it looks like you guys can see me as well. So getting through like what we're trying to do with this whole little thing, talking about psychology and then TA and how it all ties together. It's going to be a little bit of like a trading basics as far as identifying trend from the highest time frames to the lowest time frames, and then the kind of the market psychology that goes with it as far as failures that take us lower. And the idea here being mostly is that you're identifying the high time frame trend because it'll tell you a lot about is it in an upside trend or a downside trend. So Bitcoin, obviously, if you go on the monthly, that's about as high as you'd want to go. But there's no reason to go higher than the monthly time frame on Bitcoin because it's simply, you look at the yearly and it's literally just up only. But with this, you can identify things that are really important, such as levels that you gain or loss. So the big thing to understand with levels is that levels essentially show you points of kind of like range levels, like high of the range, low of the range, gain and loss of stuff. And we'll go through that here in a second. So the big thing that we have to kind of get out of the way looking from the highest time frame is where's the upside trend? Use your eyes. It's not hard. We're making higher highs and higher lows. On macro market cycles, Bitcoin is going to the upside. We know this. It's not news, but it needs to be said. So with these levels that we test, essentially that break and move back to the upside, we also now can see where there's failures. So the big thing you want to do, of course, from like the start of everything is identifying what happens at highs and why do we fail them. So looking at, for example, the all-time high, right, we put it in, the index says 68.9, it's 69K on spot for Tether. Same difference, right? Now with this, you get a lot of interesting data as far as like, okay, if that's the high, then we failed. Why did we go lower once we failed, right? Why did we break down? Where was the capitulation that took us to the downside and created new lows? So the capitulation we can arguably say was on the next monthly. You can have a lot more confidence in saying, well, it was after we did this. We essentially restricted and failed. And why did we do that? Well, there's a pretty interesting level there. If we just look at that as an example, 47.1. That's an interesting one because if you look at that monthly, that's the high of that monthly as far as where it closed. And then the low of it as well. We essentially saw failure to gain to go higher. And everything that we look at, we want to see things that go to a level, gain it, and then go higher to the upside, right? We didn't have that. We had failure and movement to the downside. So using the higher time frame, we can then infer where stuff is going and why. Looking at the weekly time frame as well, stuff starts to become really, really simple as far as like where's the failure. We can break it down even more. So looking at where we gained essentially to go back to the upside, you can break it down on a lower time frame. Where did we fail and why? Well, you can bring it all the way back down to essentially that level, that 60K, 60.5, around there. And by the time we failed that, there was nothing left essentially to gain. There was no targets. There was nothing that we could really do. And if you look at the higher time frame of like what this upside structure is, and the reason I'm going through this is to kind of give a picture of understanding it from the high to low time frame. So this is essentially the gain, right? This is the weekly gain of the previous high that led us to the all-time high, right? So if that was the gain, what's the loss of it? Well, when you're looking at a loss of something, you're looking at things that are the all-time low of that range, essentially. So you're looking at the wicks to the downside. So you have the low of the range, absolute, the high of the range, which made the all-time high, and then you have essentially the level that you gained that led us to the high. So all these three things are key components in understanding a high time frame structure, and then when you test, reject, and essentially capitulate and lose. So we knew by the time 57K was lost, right? That bearish, that weekly that moved up and then down, the upside was done. There was no regaining of anything. The entire upside structure was lost, and then we battled down here on these like low points for what seemed like forever. And we can break those different ranges down individually. We can look at just using our eyes. Where did we test? Where did we fail? We created some more range structure right in here back in December of last year or 2 years ago, 21, right? We failed that. Failed to regain back into test structure, couldn't even test it. And then we moved all the way back down, and then that floor was then perfectly retested and failed. So for the guys who've been around for a while, you guys know why we giga shorted the crap out of this back in, April 1st of last year. Because there was no regaining any of this structure. We've lost everything. We've lost the monthly levels, we've lost the weekly levels, the daily levels. It was done. So how can we use that information to kind of infer where we're going now and what we're actually doing? So again, and I'm just going to use this because it's easier for me. I like shorting. I like, longing is fun and easy, but also identifying tops is pretty much a really simple thing to do. And even psychologically, it's a lot easier to kind of look for longs, which is why I invert the chart quite a bit. So using that same kind of like mentality of what are we testing, what are we not testing? Well, look at what we've done in the upside move here. What did we test to the left? What's the important stuff that we've tested? So if that's the all-time high, right? Where was the level? Well, where was the loss? Right? And then what was the low of that range? That. So what we essentially have when we look at these kind of plans is, well, where do we have gains and loss of levels? What do we have for retesting and whatnot? And that's kind of like the overall, that's the level that we gained that took us to the high. And that's the level that we lost that started failing back to the downside. So the more you look at these kind of structures, the more you can kind of see, okay, well, we've got that range low there. That's a pretty interesting one. That really ties into essentially that. It's not super clean, which is why I'm not going to use it. And then we look all the way to the left of us using all that extra information. And yeah, we essentially have, a very old test of a much lower level, which technically was already done. So it's not important, right? Because when we had this move down, we still bounced back up and tested the level. So I'd be more interested in that. Did we get it? Yes. So that the highs going back into the previous bull run are all fully tested. The only thing we can test is if we lose that, make new lows, where are we going? We're going to at least there. Has that already been tested? Yes. Has that already been tested? Yes. Where can we assume we go to if we start losing levels? So now that we're starting to see that things test stuff and why they test stuff, it'll start to help us identify high time frame moves of like, okay, that's a pretty good probability of a target if we lose the low here or gain it to go higher since we're inverted. So using this kind of model as far as like the level we've lost, the levels we've gained and whatnot, it also helps us identify stuff on lower time frames. Because now you had a high, you created a high, you lost it, you bearishly retested the level and came back to the downside, and you're still failing. You're now testing structure and stuff to the left of you, right? All of these are tested. That is not. There's also stuff here that's untested. So again, there are bigger levels, higher time frame levels that we want to test higher and above, like below current price action. So re-inverting the chart, looking at some of these levels, it can be a little, discombobulating, saying like, okay, we got all this stuff, we've got gains, we've got losses, where's the next step essentially? Well, let's identify the stuff going into the local price action, the local structure, right? We'll go down a time frame from the weekly to the daily. What are we doing on the daily time frame? Are we still holding structure? And this is going to be an interesting one to talk about. Because essentially what you have is you have your previous high, right? Not a whole lot of help because it's already been fully tested. You got the level that you gained that took you to the high, which is what you're holding now. And then you've got levels essentially much lower that are untested. So when you talk about the levels that are local to price action, the important keyword here is local. If I'm targeting stuff down here and not targeting stuff that's up here, I'm wrong. You don't target stuff that's outside of the local purview. A lot of people will focus on this. Well, they'll start saying, well, I want to do a 10x on this trade, or I want to 10x my account, or I want to do this, this, and this. And they start making these arbitrary numbers of, oh, we're going here because I want it to go there, or I want my risk reward to be 17 to 1 or 27 to 1 or whatever it is. And that's not realistic. You're looking for the local test. You're looking for things to essentially, okay, what are we doing here? Are we testing stuff? Yes. What happens if we lose this? Where do we go? There. Why? Because it's untested. Levels should be tested, and we understand that. Levels are tested because the market is trying to find out if there's supply or demand in a current area or not. We've essentially made a large move to the upside. We're holding structure. We've retested this as the previous floor. So we've got some local levels. That was the level that we essentially gained that took us to the high. We then lost it, bearishly retested it, and it's now holding as the level overall on the floor. So what do we know? We know that if we lose this level, there's nothing left to test until we go lower. And if we go lower, the whole point is that if we go lower, we can then set those targets based off of the price action of levels. So what do we do now if we're holding? Well, the priority is, well, we're still holding levels. We're still holding stuff. You can look at the ranges. There's very, local ranges. We're not closing below it. And if we do close below it, which we just had it, we still need confirmation of that rejection, right? That's a very clear level of, okay, that's the level that we went above to take us to the high. We're now at that range low. This is 29.9. This is the range low we've been talking about for the last, 4 weeks almost. And we're still rejecting stuff, but we're not creating new lows. So until we close underneath it, which we got one close underneath it, we then need the failure, right? We need the current daily to close underneath it, and then we can start essentially talking about testing structure further to the downside. Until we get that, you're still looking to hold the level because you haven't lost it. The stuff you've lost to the upside, like on the daily, is all local structure here. It's all local structure around about 30.4. If you gain 30.4, where are you going? You're probably going to go test some high structure again. Now, when I look at high time frame structure, yeah, the daily is important, the weekly, the monthly, all that jazz. I will always defer to the 4 hour. Because the 4 hour gives us everything we need to see. It's that perfect, golden time zone of seeing the high time frame trend and the low time frame trend. It allows us to target structure that's important and localize things that are unimportant, things that have already tested things or haven't gone in certain places. So with that, we can look at the local structure. We know that we've tested everything to the downside here. There is untested stuff to the upside, like this previous high. Some of the low structure that we've put in, that's already done. It's already been tested. Everything to the downside is currently tested. We're still downside trending. We haven't broken anything back to the upside, even though there's liquidity forming above us. And we know that. We can use our tools, right? We can use liquidations. We can use all these different things to let us know that there's liquidity to go stuff, to go to places. But what are we doing here? Here's the important stuff. This is the 4 hours where you want to trade until you get good enough to trade on the higher time frame. What are you doing here? Well, you created a low, you've lost a level, and then instead of bearishly retesting the level, because you didn't, right? You closed underneath it, indecision, closed underneath it, closed above it, lost it, didn't bearishly test it, and then on the next one you came back up and tested structure to the left, and now you've got a bullish retest of level. So what are you looking for essentially? You're looking for high risk reward trades that retest levels and structure above you. When you're looking at the high risk reward trades, everything that I look at is 3-to-1, 4-to-1 as far as like entry and loss of level, right? If I'm going to have my risk reward ratio testing all the way to the bottom of this, I don't think it's a valid trade because then I'm expecting the loss here, which is invalidating the gain. The trend is still down, but overall, that's not a valid trade because it doesn't hit the risk reward targets, right? The better opportunity that you have with this stuff, and this is why I took a little long, got one profit target out of it once we had the test, was to target something that gives me a high risk reward ratio. Because at this point, I don't care if I get stopped out because I still have the ability to re-enter on the regain of level. And that's the whole point. It's that I can now use the fact that, well, I'm willing to risk 1 in order to gain, in this case, 5. So I'm willing to risk $10 and probably going to gain at least $50 on my trade. And I'm okay with trying it a second time and maybe even a third time, right? Because at the end of the day, your win percentage, your win ratio, and I would declare a trade as a win if you hit your second profit target, because at that point your stop loss is in profit, you've taken 2 profit targets, and now you're actually making money. So when your stop loss is in profit, there's no risk to your trade. That is a successful trade in my opinion. So your win rate does not equal profit. Your win rate for most people is not even 50%. It's in time, your win rate can become quite good, 60, 70, 80% or something like that if you're manually trading. Now, with that, the idea is that if you're getting stopped out on trades, the trade is still valid until you essentially lose the level that you gain back, right? Because that would be an invalidation. If you do this, what do? If the trend is still down, you essentially still have good validation to flip your bias and take the short. And you can then target stuff much, much lower, potentially breaking to the downside. Now, personally, like I said, using some of the metrics we have, we can see things like, okay, we're oversold, and we're starting to break back to the upside now, even though we're deviating and still coming down. All these different metrics that we have to support us in our trades, right? We can we can infer levels, especially when they line up within, $50 of each other. That's a huge, important level then. And then we have targets of stuff and higher time frame levels above us. So what we're trying to do with all of this is to find high probability trades based off of gain and loss of level. Where's the trend being broken? Well, here, technically, you're gaining back what you lost, right? You lost it, it went to the downside, and now you're bullish regaining it. Now, price is still coming back down, so what you're looking for essentially is a potential hold. If you get the long entry here to go higher, then that's a good trade. But what happens if it goes against you and it keeps coming down because it's breaking a little bit back to the downside? Well, if it stops you out, the only way I would say that a long is invalid is if you make new lows, because then it just follows the trend anyways. And if you're not shorting the trend because the trend is down, then you're wrong. At the end of the day, all we try to do is identify the reversal points in the overall trend. And when we actually fail important things, but either to the upside or downside, then we flip our bias. Because nothing's happened essentially since Sunday night, and it's already Wednesday. We're still trending to the downside. We're seeing the first potential failure that would take us back to the upside on a higher time frame. Is it confirmed yet? No. Why? Because we're still essentially testing. Are we starting to see some failure? Yes. What's the confirmation of failure? Rejection. And that's the whole point. And if you have these high risk-reward ratio trades, then it doesn't matter what it does overall, because you're still able to lose more trades than you win, and you're still profitable. Your profit factor is higher even though you're losing the majority of your trades, which blows people's minds. It's crazy. It's like, well, I want to win 80 or 90% of my trades. Like, that doesn't matter. Winning trades does not equal profit. If your profit factor is over your drawdown, over your overall loss, then you'll actually make money over time. So we talked about the identifying a high time frame trend, the monthly. We talked about what are we doing right now, identifying weekly and daily, where things failed and where they're tested. The majority of times when we lose the high or gain the low and test it, it is a confirmation of trend change. It's higher probability. So you can identify these trend changes on the weekly, the daily, and lower, right? And if things are not tested in one direction, the probability is things that aren't tested will be tested, if that makes sense. What I mean by that is identify things on the high time frames, like the weekly, things that are untested that haven't been tested. Very clearly, there's some levels above us. Very clearly, there's some levels below us, right? Untested levels get tested. And the reason they get tested is because the market is trying to test to find out, are there still buyers or sellers in control at this point or not? And that's all we're doing over and over and over again. So that's essentially one of the biggest parts of this whole thing. And then as you look at the lower time frames, again, 4-hour low exposure, that's the whole thing. The gain and loss levels that led to the higher the low, that's going to be your priority as far as gain or loss. Now looking at the weekly, if I get rid of some of these, just delete these levels real quick. What did we gain that led us to the high? Just looking at the local structure, right? Isn't that the local level overall of the gain of loss of level? We gained it and led us to a high. That was the big level to the left that was holding us down. How about the local structure that created the high? Have we gained that? The previous high? No. What about on the daily? Anything? No. Every time we stab above the previous all-time high, we have a close above, but no bullish backtest of level. So what can we kind of infer with this? We're at the low of the range. The range is still valid. Even going to 31.2, I could argue that as well. It's what I've been playing in the local range. You're holding the lows at 29.9 until you lose it. You're supposed to short the collapse of structure back inside the previous range. So looking at that, looking at the previous levels, we know that even if we pop 31.4 on there, we have a failure. Or 31.2, there you go. We have a failure that led us back within the range. So this is the local range. Failure, retest, back in the range. Failure, back in the range. Pop above, bullish test, rejection of the high, happen on the next 4 hour. Rejection, new lows created, larger new low, and now we had the bearish retest of that failure. And what that looks like over time frame is this. You essentially have the level that showed you the failure. Pop down, test, retest, test the highs. Failure, new low creates a low. Failure to regain that level, and then failure back under the bigger range led to new lows overall in the structure. So when that happened there, this changed things. Because now from gaining levels, because you technically gained it and went higher, then you failed, then you went lower. That initial failure, because you actually failed back within the range, is considered a failure in the price action movement. So when people are like scared to short levels, this is what I usually talk about, which is, well, you popped above, you gained the level technically, and then in the next 4 hour, you failed to gain the high of it. Right? You failed that swing. Pretty perfectly, too. Close below, bearish retest, failure back within the range, new low created. So what you've now done, essentially, is that not only have you failed the high of it and gone lower, you've created new lows in the previous price action structure as well. And that trend is still continuing. So until that changes, where's the priority? The priority is down. Now invert the chart. That loss back within the range, are we doing that now? Pretty damn close to it. What's the invalidation? That's the invalidation of the bounce, right? So if we believe this is true, that we've gained back within the range to go higher, we must also believe that this is the failure at the high with the chart inverted to bring us back to test untested levels. What's untested on the 4 hour? That is. What else is untested on the 4 hour? 31.2. Where's liquidity? If we gain there, where's our target? Probably liquidity, probably May. If we bearishly testing it, which we technically are now, where's our target? Our initial target will be the weekly open, and then 30.4. And then what else do we have? We've got July Q3, we've got some liquidity, and then we've got some larger untested structure lower. And now, essentially with this, using liquidity, you can then now start building a plan as far as risk-reward ratios. And the ratio is going to be everything, because I don't care if I get stopped out if I have a high risk-reward trade. Let's say I'll just target the weekly open. That's not a bad, 3.8. It's not great, not terrible. It'll do, right? That's my initial profit target. That's my first one that I care about. That's going to be important. What's my second profit target? If that's going to be number one, because every time I plan a trade, that risk reward needs to go to the first profit target. Where's the second one? How about that high at 30? How about this one? Is that a pretty decent one? Yeah, I think that's pretty good. So where's the second one? Second one would be really close, right above it. Once number two's hit, what do? That stop loss, we'll move back. Not to test that high, but just below it. So it'll be in profit, round about there, 30K. And that way, once I get profit target 2, my essential profit, my trade is essentially at a positive loss or profit, like in general. So once that's hit, I have no risk on my trade. My risk goes to 0. Once profit target 1 is hit, I'll move my stop loss back to break even. So that's usually what I do because I'm very risk averse in my trades. As soon as profit target 1's hit, stop loss to break even. Profit target number 2, stop loss into profit. That makes sense? And then what do you target above that? You can do July Q3 and take some really aggressive trades right here. I would probably do the same thing. Take some aggressive trades around July Q3 and leaving a large percentage to come up and target 31.2 if we grab some of this liquidity. And there's some levels we can start targeting to the left of us as well. We could say, well, that's a pretty interesting gain there, which it is, 30.8. So that's probably number 4 in my mind, because that was the level that we did what? That was the level that we gained that led us straight to the high. So this is a very strong target, because if we gain that, where are we going? We're going to go test the previous range. So there's a couple things with that, and then what's the next one? Probably there. And where you target your percentages at, I would probably take an aggressive one, 20-25% on the first profit target, and then I'd probably angle it down, probably 15%, 15, all the way down. And once it hits here at like 31.2, 31.3, I'm done. I'll GG. And this is on a fresh trade, right? Like this isn't considering that I already have long exposure. It's just an idea of, I have no trades open, and now that's my essential look at where I want to go essentially, with the stop losses as well. So we've done that, and we've looked at it from the higher time frame of essentially a long perspective. Your risk reward ratio, like I said, must be towards your first profit target. And where's the next one? Well, let's look at it from a potential loss, right? If we have that continuation failure to the downside. And to make things easier, let's invert the chart, because longing is easier than shorting for a lot of people. So what are we doing here? Testing structure. It's technically a gain, right? It's a level that we gained that led us to the high. We're bullishly testing it to test essentially the high structure here. But because prices, we didn't get the entry, the short at 30.1, what are we trying the long, since we've inverted the chart, where do I want to target for my first profit target? Well, I want to target the liquidity, right? So this would be a bit of a more broad one in my mind. Where's the entry? Well, if we lose this, right, and we come up and test the high structure, I will enter on a bearish retest level, targeting May. Now, the risk reward on that's pretty decent. It's not great. I'd probably tighten it up, keep it in line with some of the previous price action. And now we got 4.8. That's a pretty decent one. But what does it have to do? Well, it has to lose a level, right? It has to first lose the level, then bearishly retest. So the way I structure most of my trades out, as far as what I'm actioning, is that I'll say this thing is probably 2 steps away from a trade, right? It has to do the first thing, which is lose the level, and then it has to bearishly retest it, which is essentially the entrance of the trade. Conversely, the long is 1 step away from the long, or already actioned, right? Because all we're waiting for it to do is test right here locally and then continue up. So that's how you look at it from that perspective, or at least that's how I do, which is I don't care first of all, again, I don't care which way price goes. It doesn't bother me either way. That's the best way to think about it. If we're gaining levels here, which technically we are, we're bullshit backtesting structure to go back to the upside. If we lose it, what's the expectation? If we lose the daily open, you're probably going at least to the high. Is that a lot to go on? What is this? to $150 move down. Is that something I can accurately target percentage-wise with the 4-hour? No. I'd probably be looking at a lower time frame scalp. Does the 1 hour play out very similarly to the previous structure? Yes. It's still valid. It's still relevant. The 1 hour is still a good level, essentially, to use to target structure and to take profit and essentially look at levels for testing. So what are we doing? Are we gaining? Yes. We're still technically above it. What happens if we lose it? Where do we target? The low of it. Can I get a risk reward short out of that? If I target the highs and we do a bearish retest of level, it breaks us back down, and that barely. That's not super attractive to me as a trade, but then again, I could technically still do it if it's in my parameters. The problem that I have with most of the time with people looking at this is that they'll adjust it. They'll say, well, I think this is going to happen, and even though the risk reward might only be, that, I'll still take the trade just because, screw it, right? And this is where like the psychology part comes in, and it's really important to talk about it, is that when you have these kind of setups that we've talked about, when you talk about like the rules as far as trading, things that we can kind of use to constantly better our structure, our testing of things, and understanding of what's supposed to happen higher time frame and why stuff is tested. The problem that most people have is that you don't stick to rules. Now, this is an example, and I talked about it in the last Fireside, of what I use as my trading strategy. And it's very simple. I will not take a trade unless it meets all of these different parameters. And if I'm not hitting that risk reward of 4-to-1 for most of my trades, then to me, it's not as attractive of a trade. Now, I know I showed some with 3-to-1. I'd say 3-to-1 is the bare minimum. I tend to focus myself on 4-to-1 or higher, only to the first profit target. And the reason for that is I want to increase the probability of me making profit at all times. And that's a good filtering number for me. It means I can still be selective on the trades I take, and the trades I will take have a high risk reward, and therefore increasing the probability that I make money overall in that position. So just that works for me. I'm not going to tell you what works for you. And then also, the big thing there is your risk has to be a 1 to 2% of your maximum total account. Like, I will never be in a position trading wise where I could potentially lose more than 1 to 2%. I generally stick to about 1.5, but I have been up to like 2% plus. Generally speaking, that means that on any one position, I'm only willing to lose 1%, 2% total at any given time. That means I can take multiple positions, right? If I only want to use 1% of my capital and I want to take a trade for Bitcoin, ETH, Cardano, and Doge, that's 4 trades. How do I do that? Well, I just use 0.25 of that 1% and take 4 different trades. That's still averaging, or it's still adding up to be 1% exposure, but I can now spread the risk across a couple different trades that look decent, right? Because what do we know about crypto? If Bitcoin's dumping or pumping, alts are probably following in suit. Depending on dominance, depending on volume, there's going to be times when alts surpass Bitcoin in volatility and movement, which is why people trade alts. People trade alts on futures because they like higher percentage returns. Most people get wrecked on alts because they don't understand how fast it actually moves and are overexposed. So I guess I kind of wanted to finish this up like psychologically to kind of talk about the fact that people lose money in markets. One of the hardest things that people can do is losing money in markets, and I know that firsthand. It's a pain. It's terrible. It's like you feel physically ill after you've lost money trading in markets, right? And that's normal. Like if you didn't feel that, you're probably a sociopath, and you should probably be on Wall Street. The problem that most people have is they can't let go. Because one thing that you have to remember is that when it comes to trading and losing money, I know a lot of people, I know a guy who essentially longed, giga-longed at the high, saying, oh, we're going to 100K because we're going to go up, up, up. And I'm like, no, we're deviating. No, we're doing this. No, you need to take profit. He lost everything. He probably lost a 7-figure account, liquidated. and haven't seen or spoken to him in a year and a half. The big thing that to remember with all of the markets and all of trading is that you will never get your money back. What I mean by that is if you've lost money in the markets, that money is gone. It does not exist anymore. It belongs to someone else. You need to let that go. And it took me a long time back in 2017 to get, probably a couple of months to get my head back on where I could actually start trading some of the markets. Because as some of us got caught out by this move. Some people started counter trading this move, almost got completely wiped. And then was able to catch some crazy, gain of levels that essentially took us back into some crazy stuff, which made most of it back. So the problem is that happened, and I've let it go. I don't dwell on it. I don't think on it. If anything, I'll just think, oh, that was stupid. I remember when I did that. But the problem that most people have is you have to let go of the previous, if you're levels. And one of the best pieces of advice I've ever heard is about of being afraid, because the market psychology is very simple. If you've noticed, it's worth noting that this is a good experiment that you should try on yourself, which is keep a journal. What I did this for a while, especially up in the bull run, is that I wrote down every day, it's like, how do I feel at the markets? I think this is going to be the top, or that's going to be the bottom. And then I observed what was actually going on and just played the levels like TA-wise. And I realized really quick, and being able to train myself psychologically, that most of the time when I felt initially, like years ago, when I felt the most fearful, that was usually the bottom. And every time I was like, hell yeah, we're going higher and higher and higher, that's usually the top. And that's indicative of everything we know about market psychology, because you need people to essentially sell into your positions to buy the bottom. You need them to capitulate, in the same sense that you need people to buy the top because you need exit liquidity. You need people to sell to get out of the market when it's topping. And that entire psychological aspect of it is a hard thing to swallow. So one of the most important things that I ever learned about this was about risk exposure and being afraid, being scared. And I think the best piece of advice was, if you're scared of losing in a position, like you're in a position and you're losing and you're afraid, you need to reduce your exposure until you are not. So if you're trading and you're losing money and it physically hurts you, like you actually feel afraid, you feel scared, you are too exposed to the market. You need to reduce your exposure until you don't care. And once you don't care, something really cool starts happening. Once you reduce your exposure, say, oh, I'm pretty used to using 2% of my account, and or maybe I even have 10% of my account, exposed, and it doesn't bother me. Well, losing money bothers most people. So if it doesn't, that's great. But what I mean by that is, let's say in my total trades, I don't have any positions open, and I take a position. I've got 2% of my exposed capital, but I'm afraid. I have troubles if I have the trade open overnight. I'm worried about it. I can't sleep. Very simply, you're too exposed. If you have trades that go against you at 1% and you're losing money, you're too exposed. You reduce the amount of your exposure of capital to the market when you're trading until it doesn't affect you. And once it doesn't affect you, something really cool starts to happen. And that is, you start essentially retraining your brain how you react on profits and losses, to where you have no emotional reaction. So if you make money with a very little exposure, like the smallest, teeniest amount of exposure, and then you start taking profit, you're planning your trades right, you're saying, oh, I'm taking profit there. You go over on like your exchange, like BitGet, you just set like, oh, I'm going to set this limit order here for 15% of my thing. Bang, bang, bang. These are all my stop losses in place. My profit targets are hit. Great. I'll move on to the next thing and the next thing. With the exposure at a point where you don't care if it goes against you. Oh, it went against me. What happened? Oh, we lost that, and then it broke some levels. Okay, I didn't see that. That type of thing. But what happens when you do it consistently and you start actually making some trades that actually are profitable? You're training yourself to essentially not care about losing money or making money from a profit perspective. Because if you're doing this in a higher time frame, you're going to be profitable over time. People trade the 4 hour like I do because most people don't have the patience to trade the weekly, which is like, hello, look at the gain that went higher. Look at the gain that went higher. Look how toppy the current structure is, right? Where do we have to gain to go higher? And that's the problem that most people have essentially, is that they get afraid of losing money, and the low time frames or the high time frames are too slow for them. So they'll trade something in the middle, like the 4 hour, which is why I trade the 4 hour. So my suggestion there is reduce your exposure until you don't care. And then once you don't care, stick to your guns of trading with, some of those rules we've shown and talked about. Use the stuff that you have to your advantage. You want to use stuff like the oscillator, which helps to show trend change and essentially gain or loss of the stuff that we have from the auto charting tools. Liquidation levels, which helps us quite a bit. I'm starting to really like the 4 hour on the multidimensional volume delta, because it really shows you where you get like little pieces of capitulation, where then you can say, okay, wait a second, we actually capitulate a little bit there. All right, what are we doing lower time frame? If that's the high that we essentially failed at, okay, what are we doing now? All right, we're failing that and going lower. Long's out of position. We're going back to the downside. How about now? Are we seeing any major change that's helping us? No, we got 15 minutes of this 1 hour, and it's looking a little rough. We haven't made new lows, but essentially we're at the level to essentially test. We're coming back down on the oscillator in the lower time frame. So is there good probability that we break into the downside? Yes. Can we long the breakout? No, we don't breakout trade. Here it's like, okay, we're going higher, smash a button. No, because all you care about is the failure. It's all that matters. What about the 4 hour? What are we doing here? Are we still gaining? Have we still gone back above the level? Yes. What do we need essentially for this to continue? The majority of the volume needs to be out of position, right? And you want to see the next 4 hour going back to the upside. So you can use that lower time frame. You can use that based on the different levels. You can use the oscillators. All these things kind of help you essentially figure out where price is going. But at the end of the day, all of the indicators that we use, all the indicators that we have, everything is based off of price action. If it does not gain or lose the level, then all of the other data is irrelevant. And that's the only thing you can do with that is use your eyes, unless you're going to be bot trading everything, which, yeah, I think we're going to get Mr. Bing on here probably next week to do another botting session, because the bots have been going crazy, doing some really great work, especially in this kind of crabby range area. So that's pretty much what I had. And I think the biggest thing there, like I said, is from a psychological perspective, if you're scared of loss, you need to reduce your exposure until you are not afraid. That's one of the biggest helps I've ever gotten as far as advice. And then obviously let go of previous trades. If you dwell on bad trades, it'll eat you alive. It's like dwelling on the past and things that you can't change. You can't. Because what you'll do with that is that you'll doubt your TA. Because learning TA like this is not hard. Using levels like, simple things, like for me, I use the swings, right? I use the swings, I'll put it on the bodies, and then I'll usually put it at 7. It catches most things. And it gives me very easy identifiable levels that are super important to the local price action, right? And they are. So use your tools, understand your own emotions, and if you are losing pretty effectively, then I would really, really recommend like asking more questions in the chat, sending DMs, that type of thing. Just because at the end of the day, most people are a little bit afraid to ask questions sometimes. I understand. It's most traders aren't very social people, or some people are overly social. It's a weird eclectic mix of people who trade. But be curious, ask questions. There's the only things that you hurt by not asking questions is your own development. Because this stuff isn't going away. The gain loss of levels, price action, all of this stuff, especially with AI coming into the mix, it's going to be more relevant than ever. And more people are going to get into trading, especially going into the next bull run. We've got fresh money going to be coming back into the markets, depending on what happens with that. So I think the biggest thing here is, stick with it and make sure you're sticking to your guns of like good price action, good essential trading basics is the big key here, because that's it. Because you can learn TA in a day or in a couple of weeks, really, pretty decent, where you can find important levels, important losses, and that type of stuff. But The psychological aspect is why the majority of people don't make money, and it's that. But I think that's it. I think I'll leave it there. Let me just cut the thing.